So Michael Gerber talks about that in his book, The E-Myth. He comes up with this thing called the fatal assumption. And it's where people that are good at doing the technical work in the business think that automatically they can start a business and be good at running the business that does the technical work. Well, these are the 5 most common mistakes that I see those sort of business owners making. Now, the first one is they just generally have a pretty poor understanding of what strategy is. They believe that by being a price taker and hoping that things work out, strategic positions, obviously they're not. Strategy is all about making choices and deciding whether to be a cost leader or a differentiator and how they're going to stand out in their market. The second one is that their sales pipeline and CRM activity is all geared towards winning work and just maintaining relationships. They're not going that extra step to get the visibility of the financial outcome of all that activity. So they're not creating a forecast that actually talks to their CRM. So it means that they can't be strategic around pricing because they can't really see what lays ahead. And they're not bringing any of those insights back in to their cash flow forecasting either. The third one is that their budgeting is all done top down. So it's last year's plus a little bit. It's, we think it might be $100,000 or something like that. There's no detail underpinning the budget. And that means that if they start to deviate from plan and they want to understand why things aren't as they thought they would be, they simply can't answer that question. They don't run scenarios. They don't look at the best case, the worst case, and the likely case, and make a decision strategically on how they're going to go about, getting that budget done. The fourth one is that their reporting's all geared around compliance. So whether it's tax returns, ASIC, auditing, that sort of thing, but it's not actually helpful in managing their business. So they don't have any meaningful KPIs. They're not putting the key success drivers of the business under a spotlight every month. And, if you don't measure it, you can't manage it. And the other problem there is that often they've got overheads and direct costs all mixed in together in some sort of alphabetical listing of costs in their P&L. And that means that they can't monitor basic performance metrics like gross margin. And finally, the fifth one would be that in managing their cash flow, it's all reactive. They're not taking any cues out of their forecasting process, revenue forecasting, not taking cues from budget variance analysis. So they find themselves running out of money and it's a daily challenge. They're not doing any longer term forecasting with that.